When you look at the world of finance, everything just seems to be changing at lightning speed. We've got algorithms, new kinds of assets, a news cycle that never, ever sleeps. And it can really feel like the old rules just don't apply anymore. But what if the single most important part of investing hasn't changed at all? Not in 100 years. Okay, let's get into it using one of the most important books ever written on this stuff, Security Analysis.
So you got to remember, this book wasn't born during some booming market. Benjamin Graham and David Dodd put this out in 1934, right in the guts of the Great Depression. It was a direct answer to the absolute financial chaos they were seeing all around them. So this thing isn't some dusty old book. It's more like a timeless field guide for dealing with markets that are, deep down, still run by the exact same human emotions, greed and fear, that caused the whole system to break back in 29.
And you know what's so interesting? The book doesn't start with some complicated formula. It starts with this quote from the Roman poet Horace. It just perfectly sets the tone for what we're talking about today. It's this constant reminder that in the markets, nothing is permanent. Fortunes come and go, cycles are, well, inevitable. It's a lesson in humility right there on the first page.
Okay, so to really get what Graham and Dodd were all about, we have to kind of jump in a time machine and go back to the world they were pushing back against, the Roaring Twenties. It was this time of wild optimism, and it was all fueled by this super tempting idea called the New Era theory. And it basically convinced everybody that the old rules of value, they just didn't matter anymore.
And this theory, man, it was so simple, it was almost addictive. The idea was, forget a company's assets, forget its track record. Who cares? All that matters is its future growth. The past was only good for one thing, drawing a line that went up and to the right. And this led to this incredibly dangerous idea. If a company was good, then any price was a good price to buy it. The price itself was kind of beside the point. I mean, you're basically swapping out your calculator for a crystal ball.
And yeah, we all know how that movie ends, right? The crash of 29 just obliterated that New Era idea and pulled the whole world into the Great Depression. And that experience, that trauma, it forced a return to the absolute basics. And Graham and Dodd built their entire philosophy around one single, fundamental psychological distinction.
And this is really the heart of it all. Over on the left, you've got the investor. They see a stock for what it actually is, a tiny piece of a real business. Their method is to analyze that business inside and out, and their goal is pretty simple: keep their money safe and get a decent return. But then, on the right, you've got the speculator. They're not looking at a business, they're looking at a piece of paper, a lottery ticket they can flip. Their goal isn't to analyze the company, it's to guess what the crowd is going to do next. It's a total shift from business analysis to trying to read the mind of the market.
And this is where they draw a hard line in the sand with this really strict definition. I mean, look at the words here. Thorough analysis. That means you got to do the homework, not just chase a good story. And promises safety of principle. Now look, it doesn't guarantee it, nothing can, but your analysis, your homework, has to show that you've got a really, really good shot at getting your money back. Anything that doesn't meet that standard, by their definition, that's speculation, period. So I know what you're probably thinking. Okay, that's the 1920s. 100 years ago. Things are different now. But are they, really? Let's take a look at how those same speculative urges have just kind of put on a modern suit and tie and embedded themselves in the way our whole financial system works today.
See, instead of that New Era theory, today we've got what you could call the short-term performance derby. Big-time money managers are judged not over years, but over quarters, sometimes even months. And, it's actually safer for their career to just follow the herd. Because, hey, if they fail, at least they failed the same way as everyone else. This creates this insane pressure to always be trading, to stay fully invested even when everything's expensive, and to focus on what's popular right now instead of what's actually valuable. It's the exact same speculative urge. It's just been institutionalized.
Okay, so if this temptation to speculate is always there, it's like baked into the system. What's an investor's main defense? How do you stay disciplined? Well, Graham gives us this incredibly powerful and simple analogy to help us out.
So let me throw a question at you. Let's say you analyze a business, and you figure out it's worth exactly $100 a share. What's the risk in paying $100 for it? I mean, it seems like there's no risk at all, right? You're paying precisely what it's worth. But this is where Graham points out a massive, almost invisible trap.
Picture this. There's a bridge, and the sign says max load 10 tons. Now, would you feel safe driving a truck that weighs exactly 10 tons across it? No way, right? And why not? Because you're leaving zero room for error.
What if your scale was a tiny bit off? What if a big gust of wind hits? What if there's a small crack in the bridge you can't see? Buying a stock at its full, fair value is exactly like driving that overloaded truck across the bridge. You're assuming your math is perfect and that the future holds zero bad surprises. You're tempting fate.
And that brings us to the antidote, the cure. It's the margin of safety. And it's probably the most important idea in all of value investing. It just means you don't drive the 10-ton truck over the 10-ton bridge. You drive a 5-ton truck. That extra 5 tons of capacity, that's your margin of safety. In investing, it means you demand a discount. You find something that's worth $1, but you refuse to pay more than, say, 50 or 60 cents for it. That gap, that discount, that's your protection against mistakes, bad luck, and a future that you just can't predict.
So this kind of brings us all the way back to the beginning. Why has this super old school wisdom of just analyzing a business and demanding a margin of safety, why does it still work so well? Well, it's because it's built on the one thing in the financial world that actually stays the same.
And Graham had another killer analogy for this. He said in the short run, the market is a voting machine. It's just a big popularity contest. It's all about feelings, hype, what's cool right now. But over the long haul, it's a weighing machine. Eventually, the actual substance of a business, its assets, its profits, its cash flow, that's what gets weighed, and that's what determines its value. The speculator is playing the voting game. The investor is patiently waiting for the weighing machine to do its thing.
And that's the whole point, isn't it? The platforms we use, the speed of information, all the complex financial products, that stuff is always changing. But the person behind the screen, the human being clicking the buttons, the one who gets greedy, who gets scared, that person hasn't changed one bit. That's the constant variable. And that kind of leaves us with one last question to chew on. In an industry that is completely obsessed with innovation and whatever's next, maybe, just maybe, the most powerful and lasting advantage isn't a faster algorithm, but the discipline to stick with the simple, powerful wisdom that never changes at all.